Welcome to Behavior and Risk, where we explore the intersection of decisions, the brain, uncertainty, and the business world. I'm John Burkhart.
And I'm Rich Loria.
We're glad you took a chance on us today. What do the Bahamas, Jamaica, and Nigeria have in common? It sounds like the setup to a bad joke, but in point of fact, the answer is on the leading edge of emerging finance and the future of money. These three countries are, as of the recording of this episode, the only three countries in the world to have national deployment of a class of asset called Central Bank Digital Currencies. Central Bank Digital Currencies, or CBDCs, can be thought of as the government analog of cryptocurrency. They are a digital asset, but unlike cryptocurrencies, they're issued by a country's central bank. They are typically not tracked by a blockchain or distributed ledger, but rather by the central bank itself. And they behave a bit like a stablecoin in that their value is fixed. However, unlike a stablecoin, their value really isn't pegged to anything. They simply have the value of the currency in which they're denominated. On paper, CBDCs really are not all that different from traditional fiat currency. With a typical card or smartphone transaction, you probably really wouldn't notice any difference at all if you were purchasing a cup of coffee or a book or something off Amazon. So it would seem at first glance that CBDCs are a bit of a non-story. If their use isn't really any different than cash, why do they merit any attention at all? And the answer here is that, as is the case with every emerging asset class, there are peculiarities and nuances that we all really need to be aware of. Despite CBDC's value proposition, there are significant risks associated with them, and we need to be able to make informed assessments before we start including them in our wallets. So today, as another installment in our informal series on the future of money, we want to talk about what CBDCs are, how they operate, what they purport to do, and what risks exist around them and their use. Now, Rich, as I was preparing for this episode and doing my research, one of the things that really grabbed my attention was how widespread interest in CBDCs seems to be. I've done a number of projects with a particular global monetary fund that will remain nameless, and while we've run a few projects around CBDCs, I never really had the impression that they were this widespread. From what I've seen, numbers vary from source to source, but per the Atlantic Council website, there are presently 49 countries with active CBDC pilots running, 20 that have CBDCs under development, and 36 that are in some form of research phase. Clearly, this has gravity. I think we can safely say that it's beyond a trend and would appear to be the beginnings of a shift. So, why do you think we're seeing this? Are CBDCs really that amazing as a currency tool?
Thank you, John. I do think we're moving towards an age where being able to exchange something for goods will be done electronically. We're already largely there in terms of our habits. And I think the generation that's currently growing up, those who are age 30 and younger, I'm going to guess a lot of those folks don't carry any cash in their wallets, that they do everything through either a card or a chip or something to that effect, or through their phone in many cases. So to me, the CBDC trend is really the monetary authorities' recognition of this desire for more privacy, more convenience, more accessibility to funds, and providing the ability to have financial security in the types of transactions that individuals around the world take.
And I think that's a very important call out. I think that we need to level set here that for purposes of our conversation, most people in the West and other developed economies really utilize very little cash in their day-to-day lives. We talk about this as though it is a radical new paradigm, and in some ways it is, CBDCs. But in point of fact, we've all been using ad hoc digital currency for many years now, possibly even decades now, just not central bank issued digital currencies. It's been commercial bank or credit card issued or at least tracked digital currencies. So are there really any major fundamental shifts considering the fact that we have been using this ad hoc digital currency? I mean, I have my own thoughts here, but I'm curious how you see the situation.
Well, I do see a difference in that, to your point, the so-called electric funds that have been created in the last several decades have been largely issued by commercial banks as part of the savings and loan paradigm that really drives a lot of the world. So, what I found interesting in my research on this was just how new money supply is actually created today, which occurs typically when someone makes a bid on a home. And typically they're making a bid on a home, not in all cash, but usually in a leveraged way. So again, that money has to come from the bank. And there may be an impression, and I know I had the impression, that the banks just go to a vault and there's a bunch of greenbacks sitting in there and they take the greenbacks out and they hand it over to you. But that's not what happens. And I remember even when I bought my apartment 25 years ago, that I didn't see any cash pass through my hands. And I can tell you, I wasn't anywhere close to paying full cash. I had to leverage quite a bit in terms of being able to pay for my apartment. And I always wondered, like, where did that money come from? Because I never saw it yet. The seller of the property was fine. They never came back to me. I just handed in my check, my piece of my, I think it was 20% or 15%, whatever it was. I just handed that over. The bank did some other stuff and we were done.
So clearly they
So,
got the money from somewhere. Either that or they just really liked you.
I, yeah, I don't think they didn't know me, which may have contributed to that. But no, that was what I've come to realize is that the bank, the commercial bank, actually comes up with the money. It's just another account that's created. And in effect, it just increases the money supply from where it is. And the underlying assumption, of course, is that that loan is going to get paid back with interest. So it actually turns into some type of true cash, true earned cash, as I make my mortgage payments, which I did. And I'm fully paid off at this point, thankfully.
And I think that gets to a really interesting separation in terms of different use cases that have emerged globally for CBDCs. There are two very broad classes that I've come across, the retail and the wholesale CBDCs.
Yeah.
Retail being what you and I would think of as cash, or not cash in the traditional sense, definitely not paper money of any sort, but funds that sit in our bank, a cash analog that we could go to an ATM and pull cash out for, something that we can use to make everyday transactions for individuals, households, or retail businesses. The other class is that I've seen is wholesale CBDCs. And these are exclusively utilized by financial institutions operating similar to bank reserves. And that sounds very much like what you just spelled out there, where you have institutions that create accounts, or in this case, the central bank in the United States, the Federal Reserve, would spontaneously generate digital currencies in response to a particular demand, whether it be for a mortgage or a bank loan or some sort of transfer
A
of
business
reserves to
loan.
a
Yeah.
financial institution.
Yeah. Yeah, absolutely. So I think the CBDC that we're talking about now is really more of a formal creation coming directly from the central bank. That is not something that at the retail level has been occurring. So what you and I have been talking about for the last few minutes is more of the commercial bank working closely with retail consumers through their savings and loan practices in terms of creating a money supply.
And what's really the benefit then? It's difficult to see. I've heard, particularly in the context of developed economies, CBDCs described as a solution in search of a problem. On the wholesale or institutional side, what's the benefit then of going to a central bank issued digital currency rather than a traditional cash slash ledger based issuance of fiat currency?
That's a great question. I think the question becomes who does benefit? And there could potentially be winners and losers from this, which is why a number of countries are exploring various pilots, as you alluded to in your opening, John. We don't exactly know where this is going. And what we do know is that the three countries that you named. And by the way, when you named those three countries, the first thing that came to my mind were countries that seem to produce really good athletes in summer running kinds of events at the Olympics. But besides that, the interesting thing about those three countries, as you pointed out, is that they do have formal CBDCs. And I would also posit that those programs have had marginal success at best. So there's been some real issue in terms of uptake, which is a little bit surprising because these are all countries that I wouldn't say are necessarily first world countries. And therefore, I would think that having an electronic money supply would increase access and therefore provide more inclusion to better pump up and foster their local economies.
Yeah, that's something that I've seen repeated over and over again in the readings that I've done. A few different points. One, that CBDCs are a safe asset, and two, that they facilitate financial inclusion. The safe asset, I can absolutely see in emerging economies as hopefully being an attractive alternative to, for example, cryptocurrencies or other volatile instruments, and by extension, then moving more people into the central currency. This is very important for emerging economies to strengthen and stabilize the overall national economy. The more participants you have, the more stable and the more able to withstand system shocks the economy is. And then this notion of financial inclusion. I've, I'll be honest, I've always found this to be a kind of curious phrase, and I'm not really certain what it means. I've seen it used over and over and over again. And the typical rationale I've heard is, oh, it helps include underbanked or unbanked individuals within the economy, which absolutely is a fantastic premise, is a fantastic, worthy goal. But one of the major limitations to modern day banking, one of the major reasons people don't participate in traditional banking is lack of access to digital infrastructure. Because practically speaking, you need access in order to participate with a contemporary bank. And I'm not really sure how CBDCs resolve that because you need basically the same electronic infrastructure for CBDCs as you do for traditional banking. So my kind of suspicious brain, my government skeptic brain, sometimes wonders if financial inclusion is just government speak for let's get everyone's accounts visible to oversight in some capacity. I don't know. Am I being paranoid? Is this tinfoil hat territory?
No, and I think there is something to that. I do think that having digital wallets gives monetary authorities and thereby government authorities more oversight, more transparency, right? Which, again, one of the things we've talked about in prior related sessions is the issue around money laundering and funds being used for criminal activity. So this is a way, sort of a backdoor way for governments to have more insight into what's going on and how funds are being used.
And this leads to one of the other benefits or use cases I've read for why CBDCs should be explored or adopted by governments, and that is that they facilitate unconventional monetary policy. And I love this turn of phrase. I think this is fantastic because nobody likes to say things like negative inflation or deflation or the automatic revaluation of currency or the selective revaluation of particular assets within particular accounts. There are reasons why governments might need to do this. For example, if you look at countries that are experiencing radical inflation or hyperinflation, then yes, the ability to revalue the currency on the fly probably would be highly beneficial. But to your point around, for example, money laundering, a central bank issued digital currency with a central register of transactions would enable a government to inactivate or disappear dollars or euros or whatever currency that were found to be within a fraudulent or laundered or criminal account. There would be an ability to simply turn off those assets. And this is something that I think is a very double-edged sword. This is something that we can look at and say, this is fantastic as a crime prevention or crime mitigation tactic, but it's also a little terrifying as somebody who then now has uncertainty as to, will my dollars be turned off? Will I not be allowed to spend the money that I've earned?
Technology is a tool. Technology in and of itself is neither good nor bad. It comes down to the purpose with which it's being wielded. And what you've touched upon are the two sides to that coin, that it can certainly be used for many good purposes in order to bring a more functioning and lawful economy that provides really valued services to businesses and people. On the other hand, governments can possibly use this same technology to wipe out individuals, completely wipe out any sort of wealth they have. And I think that sense of vulnerability that comes with it will always, at least for the near future, I think, lead to some type of hybrid where I don't think we're going to completely move to a fully digital economy. But at the same time, there will be somewhat of a transition to more of a digitalized economy because of these benefits of it. One more point I wanted to make about this is that it really comes down to having appropriate checks and balances against those who have the power to make decisions about it. So there needs to be real steps put in place from a legal standpoint in terms of withholding funds and so forth, especially when we're talking about it in a digital context where you can just press a button and do some pretty radical things to someone's wealth.
And I think that the adoption numbers we're seeing in countries where CBDCs have been fully deployed bear that out. It was hard to come across good numbers for Jamaica, but in both Nigeria and the Bahamas, national adoption for the CBDCs, and by the way, just sort of interesting sidebar, the Bahamian, uh, Bahamian CBDC is known as the sand dollar, which is a fantastic name for a currency. Rates of adoption in both the Bahamas and Nigeria are under 1% nationally. And this connects, I think, to a much broader challenge that many emerging economies are seeing when they are exploring and researching CBDCs, which is adoption in general seems to be highly correlated with level of trust in the federal government and in the central bank. And if there is low trust in either of these entities, adoption for CBDCs is phenomenally low. And the nature of the beast is such that unless the government simply wants to turn off currency entirely, there needs to be a critical mass of adoption. If you can't have, I mean, I'm sure there would be an economist who could tell me what the threshold percentage is, but I would imagine well over 30% of the country adopting CBDCs. You really can't get a viable national economy based on digital currency.
Yeah, I mean, I think, again, a lot of these countries, the tendency is to not want to hold that currency or not place a lot of value in that currency to begin with. So the fundamental problem is building a real belief in the population to use the local currency and that the local currency has real genuine value to purchase goods and services rather than going and say exchanging that local currency and loading up on US dollars or euros or yen or some other currency that has much more global appeal and recognition.
And I think there's a double hit here. I think there is that lack of trust in many cases in the native currency, whatever it may be. And then I think there is a problem of, even though they are foundationally different, CBDCs seem a lot like cryptocurrencies. I think we get a really big problem of representativeness here. I think this is a major barrier to adoption. CBDCs are digital assets. Their transactions are tracked by some distant ledger somewhere. It sounds a whole lot like crypto. And so we have a problem of representativeness. We just have this mental prototype of this is how digital currency works. The value is volatile, it fluctuates. I don't know about this one. If I'm inclined to get digital currency, why don't I just go get Bitcoin? And I think this is going to be a major barrier to adoption until there is much broader understanding of what CBDCs actually are. And then we get a bit of a chicken and egg problem where without widespread adoption, how are people going to come to better understand what CBDCs are?
Yeah, and I would say that combines with availability bias in terms of the recent issues that stablecoins have had. So if you've got a representativeness issue, it wouldn't be a problem if stablecoins had a largely good history. And while there are certainly stablecoins, and we referred to this in our stablecoin episode, that have been successful, and in fact, there are, I believe, if I recall, two or three that are pretty much dominating the market and are pegged in some way, usually to the US dollar. There are many examples that have completely gone into the abyss. So if individuals are making that association, and it's an understandable association, then they're also going to look at the availability of recent history and say, wow, that's something I really don't want to touch. And especially given some of these currencies that we're talking about are volatile to begin with. So if this is just supposed to be a representation of that actual currency, even if you convince people of that, it may not get you anywhere because that currency has not had a good history.
And all of this serves as a major barrier to adoption. Of course, that destabilizes the native currency even further or makes it even more volatile just because you have lesser participation. And you get back to that sort of circularity of CBDCs are nominally a safe asset because they move more people into the central currency. But if you're unable to do this, then they really aren't that safe in the global sense. They probably have some stability within the local economy, but increasingly, global stability is more and more of paramount importance, I think, for every economy.
One other thing I'd like to connect to this is mental accounting. And that gets to part of the challenges with moving towards this hybrid. So I've been alluding to the fact that I don't see CBDCs as completely displacing traditional modalities of holding cash, but I also see the fact that you've got an actual dollar in your wallet, a physical dollar in your wallet, and then that's supposed to represent the same thing as this digital coin sitting in your digital wallet. And somehow, I'll just speak for myself, and I'd love to hear from our audience what they think about this. I have a hard time really equating those two as the same thing, even though I have been moving money electronically around for decades. There is something about when I go to the ATM and I actually see cash come out of a machine, actual bills come out of a machine. There is something about that that feels a little bit more real. And that gets to, I think, maybe a little bit of a subtle aspect of it that we haven't touched on too much yet, which is some of the generational differences, particularly here in this country.
I believe we did discuss that in the stablecoin episode. There is research that shows that people are sensitive to small flaws in currency. The research I'm aware of was in dollars, and where if you were to introduce intentional flaws, even if people did not specifically call them out, the valuation they attributed to the dollar in the sense of how much coffee, how many pencils, how much rice could you purchase with this dollar, their valuation changes when you introduce these flaws. It's called the monopoly money effect. And it is comparably shown that people do not make the same types of decisions with hypothetical money as they do with cash. Now, it's very important to point out that this research was done there in Gen X and older populations who grew up in a cash economy. And when I say cash, I mean physical cash. Bills and coins were the order of the day. I'm not aware if this experiment has been replicated in millennials, Gen Z, and younger. And it is a reasonable question to ask if these individuals would show the opposite effect, that physical cash might be play money to these individuals because it's never been the major repository of value. And this, I think, means that there are substantial questions we need to answer in terms of mental accounting and what is the prototypical dollar generationally. Are there generational differences? I'm not sure anybody knows. And the answer to that question will heavily shape how people interact with the economy and how they save and spend what dollars they have over the next 20 to 50 years.
Yeah, as you were speaking about that, John, it brought back to my mind my days growing up. And as you and I have talked about, I come from a family that enjoys gambling, that enjoys places like Las Vegas and Atlantic City, and enjoys putting a coin here or there on the ponies. And I remember distinctly going to the bank and saying, okay, I'm going to take this physical amount of money, I'm going to bring it with me to the racetrack, and I'm going to gamble it. And it's quote unquote, as you said, free money. It's money that I have designated for this entertainment. And once that money is gone, then I'm just going to sit by the rail and watch the rest of the races. So if I decide to wager all of it on the first race and I lose, then I'm stuck for the day. I wonder in an era of everything being in a digital wallet that you can't physically move from one account to the other, the way that our brains naturally think about things and have done from an evolutionary perspective over millennia, I wonder if that kind of discipline gets muted or in some ways could lead to future bankruptcies. I mean, I'm just speculating, but I know with regards to how I approach gambling, and I'll just say I enjoy some of that once in a while, as many people do. I always try to look at it in terms of a budget.
I don't think this is even speculative. I think this is very real. And I'll simply point out that coming back to the paradigm you've laid out, this is the entire reason that casinos use tokens and they don't gamble in cash. Why you can't go into any Atlantic City or Las Vegas casino and put dollar bills down on the table because they know that you make less informed, less considered decisions when you are not operating in your currency of familiarity. And yeah, I think that if the mental representation of money is primarily within a cash token of some sort, and if that persists even in younger generations, then yes, there are very real questions as to whether or not people are going to be as responsible as they want to be with CBDCs and other digital currency assets.
Yeah, I think the question is, let's say that you go to the casino and you just bring your phone with you. And you know on your phone, you've got this, whether it's just an amount with that you're just doing debits or you call it CBDC, it's electronic. So you're not taking anything physically into your hands, but you just take your phone and just whoop, right? That's your wager. And if you win, they take your phone and they credit your account. Does that make a difference in how people go about things? What I think I'm hearing you say, John, is that yes, it does.
Well, this comes back to one of the most fundamental behavioral principles, and we've talked about this, I think, in every episode we've recorded, which is if you want people to do something more, make it easier. The easier you make something, the more likely people are to do something. And in this case, in the example you've laid out, having a digital currency of some sort, whether it be a digital dollar, a digital euro, whatever, and being able to transact it right there in the moment, just off of your phone without having to go to an ATM, without having to pull out a card, just boop, it's done, makes things very easy. And in this case, the easy behavior in question is getting rid of your money. Now, this is something that we don't want to do for the most part. Most of us don't want to get rid of our money, but the easier it is to do, the more likely we are to do it. So, yes, I think this is not just a real concern. I think it's an eventuality that we are going to face with these kinds of CBDCs, associated stablecoins, and all of these digital currencies when there is some sort of infrastructure developed that allows us to rapidly transact them in the moment. Right now, our saving grace, I think, is that there are not good means of exchange without logging into an account somewhere and structuring a payment. But we all know that that is in the offing, that phone transactions or some sort of wallet or card that would allow for instantaneous deductions or debiting is going to occur probably within the next 5 years.
Some of the statistics that are out there, some of the projections that are out there, I saw somewhere that we're talking about, is it in the trillions? We're talking about trillions of dollars that are anticipated to be in CBDC accounts by 2030.
Well, I believe that's almost the valuation today of the Chinese pilot program.
Wow.
I believe it's on the order of 900 some billion dollars in digital yuan.
Wow. Isn't that a limited program from what I understand? It's not all types of transactions in China. It's
Very
it's a
limited,
subset.
yes.
So it seems like we're definitely going that way. If I could just turn our attention to something we've somewhat touched on, we talked about money laundering and that this is a way to potentially reduce the amount of money laundering because of the potential transparency. But on the other flip side of it, again, you have the anonymity of accounts. So you can't have both. There's going to be a real stress and trying to find that balance point between the two. And beyond that, I wanted to just touch on the potential for counterfeiting. So, how do you go about? And I think back to all of the old TV shows that I still watch today. There's always some type of episode involving counterfeit money where someone's really good. They've got a great printing press and it looks almost like an authentic dollar. And I step back and say to myself with these CBDCs, well, how do you know that someone puts money in your account and how do you know it's not fake?
This, I think, is one of the major challenges that I think is under-addressed, or at least not sufficiently present in public consciousness, which is, and again, we come back to a challenge of representativeness in that this feels like a cryptocurrency. It feels like it has so many similarities, but it's important to point out that this is not on a blockchain or a distributed ledger in
Mhm.
most cases. In principle, a central bank could do so, but in that case, it's no longer a central bank digital currency. It's
Right.
now a distributed digital currency. So the backend infrastructure of all of these CBDCs is remarkably similar to traditional digital currency backends, which means that all of them are vulnerable to every typical type of cyber attack. And in terms of just outright theft, falsification of funds, fabrication of funds, doxing attacks, any number of things could be done without a really, really robust back-end infrastructure. And I think one of the things we've seen time and again is that there is not a single computer system out there that is immune or invulnerable to cyber attack.
That's true. And I think that's part of why the US, ironically, has put this on hold.
Yeah. Interestingly, Donald Trump recently gave something amounting to an executive order that more or less prohibited the development of CBDCs within the United States. But even prior to that, Jerome Powell and the Federal Reserve had said that they did not see any near-term implementation or adoption of CBDCs on the part of the Federal Reserve. It's just something that is not presently in development in the United States. And this was after a presidentially mandated research and exploration period that they landed on this conclusion.
That's fascinating, John. I really think that makes the US an outlier. And I don't necessarily think it's a bad thing. I think they are being cautious about this, probably in part because of the recognition of the incredible back office requirements that it would take to really preserve the value of a CBDC issued US dollar.
I suspect it's probably coming from two fronts. I think that the Federal Reserve very likely has adopted that view and has a better understanding of all the practical and logistical goals that need to be met in order to safely and responsibly implement a CBDC. I think that the executive order, it comes more from a general right-leaning suspicion of CBDCs and major concerns around the privacy and potential malicious use or misuse of CBDCs by government agents, which is a valid or is something that governments could do It is within the remit of governments to enact fiscal policy as they choose. Whether or not it is likely is a different question. But I think in the case of the United States, you have these two converging but from opposing camps concerns around CBDCs that ultimately has held up and potentially torpedoed their development, at least probably for the next 10 years.
I wonder if it also represents the concerns of large commercial banks who their business could be somewhat torpedoed because now they're being crowded out by a central bank essentially doing some of the functions that they were doing.
There's definitely a cutting out of the middleman that goes on there. And this is not direct confirmation, but I think it's an interesting observation in light of what you just said that while the Eurozone is strongly exploring a digital euro, Switzerland has walked away from a digital franc and has said, we don't really see any valid use case for this. So both the States and Switzerland, which have highly developed, highly entrenched financial institutions, commercial financial institutions, have said, nah, we're not going to do this.
Yeah, I think those two institutions, both the Federal Reserve here in the States as well as the Swiss Central Bank, have quite a bit to lose. Those are arguably two of the most powerful entities as far as currency valuation in the world today. So for them, I could see loss aversion, status quo, endowment all coming into play in terms of their thinking around the future of a CBDC and looking and saying, yeah, I'm just not seeing the value that we're going to get from this. And there could be a lot to lose here if things go wrong.
There's a lot of inertia there. In both cases, you have 100 plus years of established ways of going about national finance. And absent a highly compelling value proposition that does not include significant loss dimensions, I don't really see any major economy going all in on a CBDC.
Then the question becomes, why is the EU looking at this? Why are they looking at this so closely? What do they think they're going to get from this? Is it a play to be the central currency in the world?
Okay, I should probably qualify the statement I just made. I don't see any major economy that has highly developed financial institutions going all in on a central bank digital currency. The EU has the EU is an interesting case because, or we should really more accurately say the Eurozone, because there are EU member states that are not on the euro. The Eurozone is interesting because it has myriad member states, but there is no central manager of fiscal policy. Each country manages its own fiscal policy, its own taxation. And so you have this patchwork connection of financial institutions, of banking regulations, of banking standards and practices. And in some ways, a digital euro probably could help resolve a lot of those challenges of the interconnectedness
Mm.
of different fiscal systems. I'm speculating here. I've not done a whole lot of research into the digital euro. I'm not sure what the value proposition is. I think it's interesting that the European Central Bank is actually pushing back against this. They have, and this maybe get to your point around the Federal Reserve and their unwillingness or their reluctance to push something forward when they have an understanding of what the back end complexity is. But the European Parliament has strongly advocated for a digital euro, and the European Central Bank has said, not yet.
Interesting. So it's those who are closest to it who recognize the potential risks and scenarios that could play out from this that are being more cautious about it.
That's certainly what it seems to be. Both the European Parliament and the European Central Bank are not the most open and transparent organizations. So, why are they taking the path that they are? It's difficult to say, but there are certain commonalities between Federal Reserve, European Central Bank. Swiss central bank where we do see certain things play out over and over again. And we do have to kind of scratch our heads.
Yeah, I think it's interesting the way this is going because CBDC is definitely out there. There are a lot of people talking about it, but yet it's still very much in a formation state. And even though I think there will be some form of it in the future, I'm not convinced at this point, especially given some of the major players that are either dragging their feet or just outright have stopped looking into this, that it's really going to take as much hold as some have speculated.
I tend to agree. I think that this some shape of CBDC will eventually become not just adopted, but probably the norm globally. And when I say this, I'm speaking on a time scale of 50 to 100 years. I suspect that CBDCs will be the order of the day. One of the major concerns around cash transactions is seigniorage, which is that is to
Mhm.
say, it's just becoming increasingly expensive to mint cash. And to your point around dollars, I mean, a single dollar bill today is only slightly worth more than the cost to produce it. And so there's definitely practical reasons to move away from the minting of cash. Now, this doesn't necessarily automatically imply a CBDC. We can still go to some sort of electronic funds, quite like we already do with commercial banks. But if we're going fully electronic, the central bank is going to want to be involved somehow. This probably means a CBDC of some shape. But yes, I don't think that the final form of CBDCs has emerged quite yet. I'm not sure what it is. And I think a major part of what that final shape looks like will depend on which currencies become preeminent over the next 10 to 20 years. It's not as rock solid certain right now that the dollar will be the global reserve, or at least the only global reserve currency 20 years from now. It may be, but I don't think it's the 100% certainty that we had about that fact in 2000.
I agree. I think a lot of the uncertainty going on is what's driving various stakeholders to consider more carefully this whole move towards an electronic currency system, a totally electronic currency system. And that uncertainty aversion is going to lead to more caution, lead to more research, and to more scenario planning before taking the steps to move in that direction. So I think you've gotten the impression, if you've been listening here for the last 30, 40 minutes, about there's a lot of uncertainty. And one of the things that I've enjoyed about preparing for this particular podcast is that there's a lot that we don't know today. There's many possible futures that can play out with regards to CBDCs. However, there will be, I think, some form of them. And the question becomes, how can behaviors, many of the behaviors we've talked about, whether it's inertia, whether it's availability, whether it's representativeness, which is huge as far as this particular genre goes, whether these things have impact and can be dealt with by the authorities that are running these various projects. And there are a number of other economic factors, and the relative balance of economic and military power globally will also influence which currencies are most accepted and therefore most potentially able to be converted in mass to a particular digital form. There's many risks associated with this. There's many things that need to be thought through, including the role of existing cash. How do we transition from physical cash, as well as the role of commercial banks, and how do commercial banks and central banks interact if central banks can issue cash directly to retail investors? As you can see, there are many issues to be worked through. They are not simple ones. And this is something that we will probably revisit in the very near future as the world of electronic commerce evolves. Thank you.
Behavior and Risk is brought to you by Capita Solutions. Behavior and Risk staff includes our research team, Sherry Xu and Jin Zhang, and our editing team, Qingying Gao and Athena Liu. Theme music by Crypt of Insomnia. The opinions presented here are solely those of John Burkhart and Rich Loria and do not represent those of Columbia University, Capita Solutions, or any other organization. We thank you for taking a chance on us today.